FIN2601, we're looking at October, November 2017. This is another past paper to practice with in terms of your exam technique and getting things right for the assessment. Remember, you have a choice. You can either start with this or that. That counts 30, that counts 40, 40 out of the 70. Okay, so let's start with the 30 for today. Let's do the long questions first, just to get them out of the way. And then you can always come back and do the longer questions. Okay, the multiple, when I say longer questions, the MCQs can take more time because some of them require some more workings. Alright, so let's start with section B this time round, just so you have a different approach. Okay, question 1. Below are the financial statements of GRAPE for the year ended 31st December 2016. So you've got a statement of comprehensive income. Okay, remember this gives you income and expenses. And you calculate profit or loss. Okay, statement of financial position talks about your assets equal your owner's equity plus liabilities. Okay, so there you've got your assets, there you've got your equity and liabilities. Right, that's it. And then they've given you required. Use the above financial statements to complete the table below. Assume a 360 day. Okay, that's important. You can't use 365. You must use 360. Purchases are equal to 70% of the cost of goods sold, right, in 2016. So that's okay at purchases. So we might need purchases depending on the formula. Okay, then you've got all of them. Current, quick, inventory, and they want GRAPE limited for 2016. Okay, was this for 2016? Yes. Okay, so the dates are correct. Right, so current, quick. I'm just going to copy them from our notes. Okay, current. So I'm literally writing down equations. These ones you'd have to study. Okay, remember, some of them are easier than others. Like current ratio, everything is current.
Exactly.
Right, with quick ratio, you just think about inventory. Can you always sell it quickly? No, so you take out the effects of inventory. What is the next one?
Inventory turnover.
Okay, so they're following the order here. And then?
Average collection period.
Okay, it's still correct there.
Then it's average payment period.
Okay. Yeah, still in line with the...
Then total asset turnover. Gross profit margin.
Okay, gross profit margin. Those are there.
Yeah.
Profitability ratios.
Operating profit margin.
Okay.
Net profit margin. Return on assets.
Is that all they asked for?
Yeah.
Okay, great. Right, so that's all I'm doing. I'm just literally writing down formulas. These are obviously ones that you'd have to study and remember for the exam. And then you just jot them down.
Yeah.
Right, there should be a mark given for that. So studying the ratios is not a waste of time. Because it's a closed book exam, you should get marks for writing down the formula. Okay, but jot down the formula so you've got it. And then do the substitution. Right, the current ratio requires current assets and liabilities. All you literally need to do is go get those figures. Right, there's your current assets, 37295. 37295. 37295, yeah, 37295.
Is it not 925? Oh, yeah, you're right.
37295.
Yeah, you're right.
Okay, divide by current liabilities. Here's the current liabilities, 19218. 19218.
Yes.
Okay, you should show that extra step, eh? I know you've just shown answers.
Well, I did work it out on a piece of paper and then I did it. So.
Okay, but remember this is a written section,
Yeah.
so don't take it for granted that your answer's correct. show workings just in case, because if you make a mistake here, at least they'll still give you maybe half for the 1 instead of getting 0. Okay, so just show workings. I know they haven't given you much space on the diagram or table, but try your best to put it in. You did get the right answer, so your working is probably correct. Okay, then we can copy that. We can put that here. This is obviously quick. So all we have to do here is just add a bracket. Add a bracket.
Inventory is 15,000.
15
and 18.
and 18.
Yeah.
Close brackets. Okay, let's just double check that. Yeah, 15018, 15018, great.
And then the answer is 2.96.
Okay, let's see. Copy that. Yes, 1.16, correct. Good. Right, inventory turnover, cost of goods sold. So inventory turnover ratio equals cost of sales. We need to get that from the question. Here's cost of goods sold. Okay, 68403. 68403. 68403 divide by inventory 15018. 15018 equals 4.55. You got that? Yes.
Is it negative though?
No.
Okay. Well,
No
I
negative.
said all, so I was wrong.
But why did you get a negative?
No, so that was my first answer.
Oh.
But
Because you had I think I know
was
why
a
you put in a
reason.
negative, because this bracket is a
yes,
bracket, so
that's
it's a
what
negative.
I wanted to know.
Yeah, you don't put the sign in because in the statement of comprehensive income, it's sales minus cost of sales gives you gross profit.
Yeah.
But the amount is the amount. Okay, so when you do a ratio, you don't use the negative, you just put in the amount. Okay. Alright, so that's inventory turnover. Average collection period. Remember, you can write the formula like this, or you can write it like this. Average collection period equals trade receivables divided by sales times 365. I prefer doing it that way, but it doesn't matter which way you do it, you get the same answer. Okay, trade receivables, here's it. 13179. 13179 divide by sales. Go up, there's your sales. 111045.
Yeah.
111045 times, don't use 360. Use 360.
Yeah.
Okay, because the question said use 360. Okay, so only because the question said use 360 do we use 360. 42 comma, but we need to put days here. Oh, that's another thing. With these,
Wait, I got that wrong.
just a note with these, you need to make it 2-1. Okay, so it's 1.9421.
Okay.
Okay, same thing with this one. It's 2-1.
Okay.
Okay, because these are ratios, numerator, denominator. Okay, this one is inventory turnover. That's 4.55 times.
Yeah, it's got them all written here.
Okay, and then so you just need to add that to your answer.
No, so I just erased my answer because I got it wrong.
Okay, so if your answer's wrong, then you didn't use the right figures, perhaps. Okay, or maybe use 365 instead of 360.
So trade receivables is.
Trade receivables.
So 13,000
is that? Yeah, 13179.
divided by annual sales.
Sales is on the statement of comprehensive income.
Yeah.
There's it.
So I used that amount, but I don't know why I got it wrong.
Maybe you typed it in wrong in the calculator.
Maybe. And then divided by 360 equals.
If you have the formula like this, then it's a divide over divide.
Okay.
Okay, so it should be, then it's a bracket here at the bottom. Okay, but if you change this formula, then it's times like that. Okay, so the formula can be written in two ways. It can be written like this or written like that.
Okay.
Okay, so you need to make sure that if you do it like this, divide by 360, you need to put a bracket there. Okay, there needs to be a bracket there and there.
So you'd say divide and then you put the bracket.
Yeah, divide, bracket, and then, Okay, yeah, you're using the
I've
financial
got no.
calculator.
I'm going to take my other
The
calculator
other one
as well.
you can put numerator denominator.
Yeah, I'm going to take that one as well because I need that one for. For Thursday. Okay.
Okay, APP, same thing. Trade payables divided by purchases times 360 instead of divide over divide. Okay, equals. Okay, trade purchases, payables, sorry. Trade payables there. 11,351.
And 7.
Huh?
And then other payables accrued, it's going to be 702. 7.
No, you only use the trade payables.
Because it says and other payables.
Trade, and other payables. Okay, fair enough.
So that's
Yes,
that's what
that's
I did.
correct.
So I added the.
Yeah, no, it's right. It's trade and other payables. So we need to add other payables. So that's one. 7012.
Yeah.
Close brackets, divide by open brackets. Okay, purchases they don't give you, but they tell you in the question. Where was that little note? Here. Purchases are equal to 70% of the cost of goods sold. So the cost of goods sold was 68403 times 70%. Close brackets. Then times that by 360 equals. Okay, 138 days. Okay, they're right.
Yes.
Okay. Next, total asset turnover. Alright, the sales total asset turnover equals 111045 divide by total assets 71975 71975.
Yeah. Yep.
Okay, same. Good. Okay, gross profit margin, sales minus cost of sales. You've been given gross profit, so you don't even have to show that working. You can just use the figure. There's it. 42642. 42642 divided by, that's the gross profit, 42642 divided by sales, 111045. Okay, this is times 100 because it's a percentage. Okay, times 100 gives you 38.4%. Make sense?
Yeah.
Okay, operating profit. Okay, so operating profit margin, OPM, equals, okay, we'll have the same working here, except you're going to divide it by, you're going to divide it by sales. So sales stays the same. The first figure we need to change. Okay, it's not gross profit, it's operating profit. Right, so we look for that. There's operating profit. 7442. So here, we're going to put 7442.
No, isn't it 37?
Operating profit?
Yeah, it's 3707.
No, that's operating expenses. Get a ruler.
Oh, okay.
Yeah, the ruler
Okay.
shows the profit.
Okay, sorry.
Yeah, okay, it's that one. Because remember, totals, those are the totals.
Yeah.
See, these are the totals. Okay,
Yeah,
so
got it.
it's definitely 744.
Yeah.
To copy, work that out, you get that figure. Times by 100 gives you that answer. Okay, net profit margin is going to be NPM. Okay, net profit margin. We need the net profit, so this numerator needs to change. Okay, the net profit is this, profit for the year, 1,999.
Yeah.
There's no dividend here. Hey, they didn't say anything about a dividend. Yeah, they didn't. Okay, so no need for a dividend. So it's just that.
Minus 0.
Yeah, you don't have to show the negative
Okay.
0, but if you want to, you can. You'll get that, and then times by 100 gives you 1.8%. Okay, return on total assets is the same numerator as the one we just looked at, ROA. So we keep the numerator there. We'll just change the denominator. So it's divide by total assets. What are our total assets here? 71975 equals, and then let's work out an answer here. There's the answer, times that by 100, 2.77%. Okay, I don't think they told you in the question to round off to 2 or 3 or 4 decimals.
So can we just round off?
I assume so. I don't know what their requirements
Should I
are.
put both answers? Should I put
Maybe just leave it as that.
2.7? Okay.
Just leave as many decimals as possible. So that is the answer.
Yeah.
But if you round off,
It will be 2.78.
to 2 decimal places, then state that. Then you would go 2.78%, and then in brackets show 2 DP, like that. Okay, if you do decide to round off, right, just so that they know what you're doing. Okay. All right, then the last one here. Profit for the year minus pref share dividend is the same numerator as the formula we just looked at. The only thing different here is its total equity, which is 41,860. Okay. Times 100 gives you 4.77544.
I got 0.5 something.
Okay, guys, just be careful. You're doing it correctly on the calculator. If there's no pref share dividend,
That's what I'm
and if there's no pref share capital, it's 0.
I'm going to take my other calculator to do these.
Okay, yeah.
So I can use the other.
Yeah.
Yeah.
All right, so that's fine. That's it. That's all the formula. How much was that for? 11.
11.
Okay, that's a lot just for doing some ratios.
Yeah.
Okay, now they're asking you to do what? Compare the 2016 values with those of Cherry and highlight the 3 major differences that exist between the 2 companies under the following headings. Provide possible reasons. Okay, 6 marks. It's 2 each. Okay, so liquidity, we're looking at
Current ratio and quick ratio.
this one, and we're comparing Grape to Cherry.
Yeah.
Okay, so let's see what we had.
So
we go up.
For Grape, we had 1.94.
1.94 and 4.55. Okay, so let's write that down. So this is 1B.
We had 1.94 and 1.16.
No, we didn't have 1.16. We had. Oh yeah, we had 1.16. Yeah, that's right. Okay. Yeah, I was looking at this one.
No.
Yeah, that's fine. So it's 1.94, 1.16.
Yes.
Okay, so let's just write that down. Okay, so liquidity. Under this heading, you'll say current ratio, Grape, equals, what is it, 1 point?
Current ratio is 1.94.
94, and then 16. This is Grape. Okay, this is the quick ratio. Quick ratio of Grape is 1.16.
Okay, that's not too bad.
Okay, no, compared to, what is the other one called? Cherry. Okay, Cherry. Okay, so compared to Cherry, what is Cherry?
Cherry was 2.48
2.48
and 1.78.
1.78. Okay, so which is bigger?
Cherry.
For which one? For both?
For both.
Yeah, so actually, who is more liquid?
Cherry.
Cherry is more liquid, okay, because their ratio is bigger. Okay, so Cherry has more current assets to current liabilities in all instances.
Okay. That's actually, I didn't know what this meant, so that's actually straightforward.
Yeah, they're just grouping the ratios, and then you have to comment. So,
Okay.
Cherry because these ratios are higher. Okay, so that's liquidity, activity, and then profitability.
I don't know what activity is, so I'm guessing it's inventory turnover and
Okay, activity is looking at operations. Okay, so if you go to your notes, you'll see that's profitability, activities, that's debt.
there's
There.
activity.
Okay, so turnover, collection period, payment period, asset turnover. So all of those four. Alright, so it's these four.
Oh shit. Okay.
Okay, then.
Okay.
Okay, that's activity.
I hope they ask this again.
I've seen a question similar like this in one of the previous past papers. I can't remember which year.
It wasn't last year's because
No, it wasn't last year.
Yeah.
It was before that, yes, but they did ask.
So maybe they might do it.
Possibly, okay. Alright, so let's record that. Inventory turnover, let's go get those values first. Okay, I'm going to copy them. Let's see, inventory turnover, okay, so from there till asset, total asset turnover, those ones. Okay, so I'll just paste them and then just delete the stuff that we don't need. Okay, delete that. Okay, so those are the four that you need. Okay, the workings we don't actually need here. The workings we can remove. This is all for grape.
Yeah.
Okay, and then for cherry.
3.49.
You've got the page there. Can we just look at them and just write them down?
So it's 3.49.
3.49.
49.32.
49.32.
Then 59.97.
And then
0.8.
0.8. Okay, so these are days. This is times. Okay, now we're comparing it. Alright, so who's better here? Grape is better. ACP, shorter is better because you want to collect sooner, not later. Longer is better. And higher is better. Okay, so here grape is better.
Okay.
In all instances, comma, grape has better activity ratios compared to cherry. Right. That okay? We're just
All good?
commenting.
No, it's all good.
Right, and the last one, profitability.
You said it was.
It's all the profit ones. So gross profit margin, net profit margin, operating profit margin. Okay, these ones.
Okay, that makes sense.
Okay, so those ones.
So it's basically from total. So it's gross profit, operating net.
And it might even have ROE as well. Let's just check. Okay, there's debt, there's profitability. It's all three of those, and including these. So ROA and ROE, so it's all the rest.
So it's okay.
So it's all the rest here. Okay, let's copy that. Right, let's paste and let's delete the other unnecessary ones. Okay, so profitability is looking at that. Return on something.
Can I just say 40?
Yeah.
Because I'll just round it off. Okay, cherry.
Okay, this is for grape.
Okay,
Okay, then we need to write down
cherries.
for cherry.
57.22%, 22.66, 15.39, 12.30, and 18.73.
Right, so let's check. Gross profit, cherry is better. Operating profit, cherry is better. Net profit margin, cherry is better. Return on assets, cherry is better in all instances. Okay, so all cherries ratios are higher than grapes, comma, indicating better profitability. Than grape. Okay, so yeah, obviously those ratios are more than those. So cherry has a better profitability in terms of generating value. Okay, and that was it.
Okay.
Was that all? Was that all the answer?
Yeah.
Question asked for?
No, then there's question 2.
Okay, so another one. Okay, question 2 is the share calculation. Okay, so that's question 1 complete. Question 2. Okay, consider the following data and the following questions. Okay, probability, expected return, expected return. That looks like a table method question. Do you agree?
It is.
Okay, the rate of return on a treasury bill is that. Treasury bill rates are risk-free. Okay, because treasury bills, that you'll learn in economics. Maybe you've covered that in like monetary policy and that type of thing.
Oh, I'm doing a lot of that now.
Yeah, so treasury bills are considered risk-free because the government issues those securities and there's no risk attached to it.
Yeah.
Okay, because we assume governments are risk-free.
Yeah.
Right, the beta of the share A is that and the beta of B is that. So that tells you beta is cap M. Do you agree? When you see risk-free and beta together, then you know it's cap M.
Okay.
The return on a broad share of market index, that's the market return, the KM. Okay, so there you go. You've got a few characteristics
I didn't know that.
for cap M.
I didn't know this is what they meant.
Okay, yeah, that's referring to cap M. Okay. Right, calculate the expected return on each share individually. Expected return means use the table method.
Yeah.
Okay, for each one. So share A. Okay, I'm going to do it this way. Probability. Then return. Okay, let's just write down share A. Right, the probability 35, 30, 35. The return for A.
0.25, 0.1, negative 0.05.
Good. Okay, you're using decimals for that. Okay, then I would do the same thing, but for B.
And the same amount, it's 35, 30, 35.
Yeah.
And then it is 0.02, 0.18, and 0.4. Yeah.
Great. Okay, then you know that there's an expect to return calculation column,
Yeah.
and that you get by taking
Times
this.
all of those and then adding them up.
Yes, by that. Okay. Then you sum up.
I got 0.1 as well.
Good. Okay, and that gives you.
And then I also got 0.201 as well.
Good. So that's 10%.
Oh, was I supposed to do that?
Because it's a percentage.
Oh,
okay, yeah.
okay.
So I'm just showing it as a percentage. There might be more. There might be more decimals here. Is there? Let's just check. No, there isn't.
Okay.
Okay, that's fine. Right. So that's 20.1%.
Yeah.
Right. So that's the answer for A. A's answer 10%.
So I must always put in the percentage, otherwise I won't get the mark.
Because it's a return. Okay, so you use decimals to calculate, but you convert back to percentage. Okay, share B, you've got that.
Well, I would have got
There's B.
marks then.
Okay, good. Right, there they just said, calculate the expected return on a portfolio that is created by investing equal portions in these two shares. Okay, there's that whole portfolio return again. Okay, so with portfolio return, we need the weightings again. So we need to go to that.
50-50.
Yeah, I just want to bring it up again just so we can recap it. This was 5, I think. Let's see, 5, 6, 7. Yes, should be 5. The risk stuff, yeah. There. No. Oh no, bonds. No, this is bonds. It's not 5, it's 4 then. Where's set 4?
There, number 4.
Yeah, but that's the PDF. I want to get the Excel document. There. Okay. There we go. Okay, so we just take the weightings and we multiply it by the returns. Okay, so weightings times the returns. Okay, so what was our rate? What was our weighting here? We need share A and B. Okay, share A, share B. Okay, what are the weightings? Equal, so 50-50. Okay, so share A's return, that's share A's return. Do you see that?
Yeah.
Okay, it's 0.25. So share A will be brackets 0.25 for the portfolio.
Times 0.15.
Yeah, times 0.50, close brackets, then plus, open brackets, share B, 0.02, times 50%. Okay. Alright, so we need to do that 3 times.
Okay, I didn't do it 3 times.
Okay, then we had 0.10, 10. This one is 18. 0.18. Okay, that's the second line. Third line is negative. So this needs to change. Negative 0.5. Okay. And 40. 40.
Okay, I only did it once. I didn't know how to do it 3 times.
Yeah, you have to do it 3 times because you had 3 probabilities. Okay. Then you just need to work out these things. So let's just copy them. Let's just put equal signs here. Okay, there's the one. There's the other. times 100 to get percentages.
13.5.
Okay. Alright, so now that we've got that, we go back. Our notes said, okay, so we've got all of that, we've done that part. Then we just need to sum up and divide by the number of events. Okay, so sum up. Okay, there's my sum. That's the total. And then divide. So portfolio.
So it's 45 divided by 3.
Return, yes. 45 divided by 3, which is 15.
Is it 15%?
Yes. Okay, and that's the answer.
For 1 mark, they should give us more
Yeah.
marks.
I agree. 1 mark is not a lot just for
We
all of
should at
that.
least give it 3.
Possibly, yes, but that's just the allocation for it, okay? Alright, assume you are a risk-free investor, okay? Risk adverse, not risk-free, risk adverse investor. Would you invest in this equally weighted portfolio consisting of share A and B? Motivate your answer. Okay, so step number 1, calculate the portfolio beta. Okay, so what number is this? 2.3. Okay, I'm not labeling these. This should have been 2. This is 2.2. This is 2.2, and then the top one was the 2.1. Okay, right. So here we need to do the same thing here. Share A and B. Let's just take the headings. Okay, the beta. What is share A's beta? 1.2. B 0.3. Right, the portfolio beta will be a weighting of the two. Okay, so brackets 1.2 times 50% plus 0.03 times 50%. Close brackets. It was right, eh? Let's just double check. Ooh, careful. It's 0.3, not 0.03. 0.3. Okay, that's better. And that gives you an answer equals. Let's see what it gives us. Okay, there's it, beta. Okay, so this represents the portfolio beta of the 2 shares.
Yeah.
Okay, so then we need cap M. Required return equals risk-free plus beta times the market minus the risk-free. Okay, so the required return would equal, the risk-free in this question was given as a treasury bill rate, 6%. Plus beta is 0.75, we just worked it out, times the market return. Market index return is, oh, I wrote over that. I can't see it now. Let's just delete this.
It's
12. Okay, so 12% minus risk-free 6%. Close brackets. Okay, so required return equals, let's work it out. 6 plus 0.75 times 12 minus 6, close brackets, equals 10.5%. Okay, that's the required return. Okay, so this is the portfolio required return. Make sense?
Yeah.
Okay, so this is what the portfolio requires. Portfolio. F-O. There we go. Portfolio return. Right, so the portfolio return requires, let's see, where are we? Here. Okay, so we've got the portfolio beta. That's done. Tick. Okay, what is the next bit? There. Step 2, use the cap M, calculate the rate that investors would be required on this investment. Tick. Okay, we've got that. There's the beta, there's the required. Okay, so step 2 we've done. Step 3, compare the expected return with the required return. Okay, so portfolio expected return equals portfolio required return. Required. Okay, so required we already worked out. That's just the answer that we got there. That's the answer. Okay, we worked it out. Okay, that's, let's put a different color. That's what we're required. Okay, this is what we're expecting. Okay, so what did we expect? We need to go back and check. Okay, where's the expected return for the portfolio? Portfolio return, was this the expected? Divide, yes, 15. There's it. Okay, that was 2.2. Okay, 2.2 was the portfolio expected return. Alright, so that's 15%. Okay, so that's 15. Right, so I'm just summarizing. I'm using those two. Okay, so what do we expect from the portfolio? We expect 15%.
Yeah.
The portfolio is only required to give me 10.5. So is that a good portfolio?
No.
Yes.
Oh.
You're requiring 10.5, but it's giving you
15.
more.
Okay.
Okay, so expected return is greater than required return. Therefore, this is a good investment to make because of the greater expected return. Okay. Right, so that's something to consider when looking at portfolios. Okay, so compare the expected. Would you invest in this portfolio? We need to answer that question. Yes, we will invest in this portfolio. Okay, there we go. Now we've covered that question.
So let's say in the exam this came up and I just didn't know what I was doing.
Yeah.
But that's not gonna happen.
Well, you need to look at what they asked you
Yeah.
to do. Compare the expected
So
to the
let's say I
required.
didn't and I answered this and I said yes, would they still give me the mark?
I don't know. It
No,
depends.
I'm not saying that I would do that. I'm just
They should give you maybe yes and then maybe 1 mark for the motivation.
Yeah.
So if you got the yes right, it would have been fine.
Yeah.
But then the motivation might not have been right.
Yeah.
Okay, we're just looking at that. That's all. Okay. Based on your calculations, is this portfolio over or undervalued? That's a separate question. That's 2.4. Okay, so 2.4. Right, so the expected return is greater than what is required. We would invest in this portfolio as it would be considered undervalued. Undervalued. Okay, because you buy things when they're cheap. Okay, so buy now when this is inverted commas cheap, and sell later when it is inverted commas expensive. Okay. Right, so that's that. That's it.
Yeah. What is this?
That's a time value of money table. So in the past, when financial calculators didn't exist, you had to do it mathematically. So in mathematics, you use these tables to do calculations based on time value of money, because all of these, see, these are rates, and then this is time.
So if you still don't have a calculator, would you use this?
Yes, you can. Yeah, you
Would
can
it
use
still give
this.
the same answer there?
Yes, it will. Well, it'll give you a less accurate answer. These are rounded off. Yeah, but you'll get the same answer. Okay, so it's just using this. This bit over here is given as a factor. That's what they call these things.
Okay.
Yeah, so these are interest factors that are used. So this is for manual calculations.
Yeah.
Okay, nowadays we don't use these things because we have a financial calculator. Yeah, but they still give these things for whatever reason.
Because maybe
Okay.
some people can't afford like.
Possibly, hey?
calculators and-
Possibly.
Because they're not cheap
Okay.
things.
Yeah. Yeah, it is possible to do it using
Yeah.
these things, but
I don't even
it
know.
takes more time and effort.
Yeah.
Okay, let's check your multiple choice. Right, so now you've got your 30 marks. We've covered that section. Okay, done. Now we're looking at that. Okay, we're covering obviously different sections here. There's always theory in every past paper. Let's just call this section A, MCQs. Right, question number 1. Let's just do it this way. 1. Okay, which of the statements on a sole proprietor is correct? A sole proprietor is the least common? No.
No.
Sole proprietor is often structured as limited? No.
It's unlimited.
Owner is the sole proprietorship
Yes.
may be forced to sell his assets to pay for company's debt?
Yes.
Possible. Owners of a sole proprietor share profits? No, they don't share
No,
profits. That's out.
3.
3. Good. Okay. Right, which of the following best describes a capital market? Capital,
Long-term.
long-term, exactly. The financial relationship created by institution that allows suppliers and owners short-term funds? No. Intangible market for purchase and sale not listed on organized exchange? No. Not listed meaning it's unlisted. It's a capital market, it is listed.
Yeah.
Markets that allocate funds to their most productive assets as a result of competition amongst wealthy? Not really, but possible, because the capital market does look at that. But it's looking at the raising of funds. A financial relationship created by institution that allows
Yes.
suppliers to demand long-term. Yes, that's the right one. That one's perfect. Okay. Okay, if everything else was equal, which of the following forms of businesses would the possibility of an agency problem be greatest? Okay, so agency problem greatest when you have agents.
Yeah.
Okay, so agents don't apply to sole proprietorship. Out. Foreign corporation that is publicly traded, if it's publicly traded, it's regulated. Less chance of an agency problem. Foreign corporation with concentrated ownership, that is relative few owners. Yes, if it's few owners, then those few owners can make decisions based on the companies, because it's few, so they can make things that benefit them. A partnership in which all partners share management decision making? No. Okay, it's actually 3.
Okay.
Right, so just remember, agency problem is looking at risk of conflict of interest. So if you're a publicly traded entity, the risk is lower.
Okay.
Because you need to be transparent. Everyone in the world can see your financials.
Okay.
But if you're a a corporation with concentrated ownership, then 1 or 2 or 3 people can decide what happens. Okay, number 4. Which of the following should be the primary goal of a financial manager? Primary goal, generating value.
Yeah.
Okay, so we're looking at share price or EPS, that type of thing. Right, maximize steady growth in the sales and profit? Definitely not. Company efficiency and minimizing operational costs? That would be good, but that's more internal. Maximize the current dividend per share of the existing shares? Dividend per share is the payout from the shares, not the value of the shares. Current market value share price of the existing shares?
Yes.
Definitely. Okay, 4. Good. Okay, here's your TVM. Alright, so you've already written everything, that's good. Natalie would like to have that in an account, that's future value, in order to retire 15 years from now. So N. How much should she deposit quarterly?
It's times 4 and
Yes, so
divide by 4.
times 4 in an account paying 10% per year.
So it's 10 divided by 4.
I4. And we're looking for the
P-
quarterly payment.
P-
How much must she deposit? PMT. Good. So let's just jot those things down.
838, 235.
FE.
FE is 250,000.
Okay.
N is 15
15 times 4 is correct.
I is 10% divided by 4.
10% divided by 4 is correct.
Yeah, and then you need to work
Solve
out
for
PMT.
PMT. Okay, let's see if your answer's right. PMT brackets. The rate is 0.1 divided by 4. Okay, the N is 60. The PV is 0. The FE is 25. 250.
50, yeah.
Did you get that?
Yep.
Option
1.
1. Good. 1838.
The whole exam was just this ad.
Yes. Okay, time value of money you should bank on
Yeah.
getting them right. Okay, good. Okay, number 6. Let's check. More TVM. Okay, Theo purchases new furniture by borrowing 15. That's PV.
Yeah.
Using the store's credit plan. The credit plan charges 80% interest compounded monthly. That's I-12.
Yeah.
And the loan is to be repaid within 3 years. 3 years n times 12. Okay, how much is the first payment towards servicing the interest? First payment, solve for PMT. That's all. Okay, so let's rewrite. PV
is 15,000.
N was 3 years times 12.
So it's 36.
Okay.
Interest is 18 divided by 12.
Yeah, so that was I-12. I-12 was
18%
18% divided by 12.
and then you need to work a PMT.
Yes. Okay, solve. Okay, PMT brackets. The rate, let's just do a little working here. Divided by 12, close brackets. The N was 36. The PV was 15. Close brackets. 542. Number?
4.
Okay. Right. A junior dentist wishes to buy a house. She can only afford monthly payments of that. PMT. 20-year loan, N. Interest, compounded monthly, I-12. If she can make a 1,000 down payment, what is the price of the most expensive house she can afford? Okay, so you need to do 2 steps.
Yeah.
Okay, step number 1, work out the PV. Okay, the payments are 1,000, right? Okay, it's a 20-year loan, so N equals 20 times 12. I-12 equals 15% compounded monthly, 15 divided by 12. Okay, do I have everything? Yes. Solve for PV. Okay, so PV equals, brackets, the rates, 15% divided by 12, the time, 20 times 12. Okay, the payment, 1,000. Close brackets. Present value, 75.
Then
Okay.
you have to add the 10,000.
Correct. Add 10,000 gives you 85.
Yeah.
Option
4.
4 again. Good. Okay, 8. Annual cost of maintaining horse stables is that. That's the annual cost. Okay, so that's payment probably. Interest 8%. How much must be set aside to pay the maintenance in perpetuity? Perpetuity means forever. So PV equals payment over I. It's perpetuity. Okay, so PV equals PMT divided by I. There's no growth. So it's just divided by R, basically. Okay, so PV equals the annual cost, 20,000. Okay, divided by, divided by, the rate is 8%, 0.08. Okay, equals. Alright, so this divided by that gives you 250. Okay, option 3,
Yep.
Okay, number 9. Right, 9 says, if the appropriate interest rate is 10%, what is the present value of the following cash flow stream?
Use the cash.
Correct. Use the cash flow function. Okay, use cash flow function.
That gives you
Year 0 is 0. Year 1 is 2,500, then 3,000, then 5,000. So 2,500. Year 2 is 3,000. Year 3 is 5,000. Is that right? 2.5, 3, and 5. Good. 10%.
option gives you option 3.
I is 10%. Solve for NPV. Let's check your workings. Okay, let's just write this down. 8508.64012. Okay, let's escape. Let's see your editor, your cash flow. 02535. Perfect. No other figures? Yes, that's correct.
Yeah,
Okay.
Option 3.
Option 3,
Yeah.
Okay. 10.
I've only gotten... No, I've got them all right so far.
That's good.
Yeah.
Okay, number 10. What amount would you have to deposit today? That means PV, question mark.
Yeah.
To have that in 8 years, that's FV. 8 years, N. If you could have interest, semi-annual, I2. Okay, let's put all of that in here. I2 equals 6% divided by 2. Okay, N here is 8 years times 2. Future value is 83,300. Okay, solve for PV. Okay, so PV equals, the rate is 6% divided by 12, no, 2, close brackets. Okay, your N is 16, your future value 83300, close bracket, answer 51.
It's option 4.
909.
Yay!
51,909, 4 is good. Okay, 11. How much would you have in 5 years' time?
Okay.
N is 5. If you deposit that at the beginning of each year, begin mode.
Yeah.
No, that's not PV. It's payment. Okay, because
Okay,
it's
well,
50. It's 50,000 at the beginning of each year. Okay, for 5 years. The interest rate is 6% compounded annually. Okay, so I1 6%. Okay, I1 is 6% compounded annually. The deposit is 50,000 every year, so payment is 50,000. N is 5 years. Okay, solve for, what did they say? How much would you deposit? How much would you have if you deposit? Okay, how much would you have? So future value. Okay, so you're solving for that. So equals future value, open brackets. The rate, 6%. The N, 5. The payment, 50,000. Okay, 281.
Yep, got it.
Good. Option?
3.
Okay. 12. Right, Jacob has 45,000 today, PV. Do you agree?
Yes.
Okay. Who is and his aunt, who is a member of investment club, states that he can turn it into 500,000 within 10 years. That's FV.
Yeah. 10 is N.
N. What is the annual rate of return? So
We
that's
need
looking
the
for
R.
the I. Exactly. Good. See, you just need to look for the variables. Okay, so PV 45.
P is 45. FV is 500,000. N is 10 years.
Okay.
We need I.
Right, solve for I. Right, so let's check. The rate equals N here was 10. Payment, no payment. PV minus 45.
45,000. And then
Future value
500,000.
500.
And it gives you option 3.
Ooh, hold on. This was beginning of every period. So begin mode needs to be 1 here. I'm just thinking back to that other one. So comma 0. No payment, so 0. Type 1. Type 1 is begin mode. So it should be 298, this one. This one's actually option 4.
Okay.
Redo that one. Okay, I'm going to put a note here. NB must use begin mode. Okay, just check it again. I'm just recalling the... but number 12 did we get right? Let's just get more decimals here.
And
Yeah.
option 3.
27.23. 27.233 is correct. Yeah, so I'm happy with number 12. Number 11 we need to go back.
Okay.
I don't remember we checked it with begin mode. So let's just do that again. Clear your calculator.
Yeah, I've already done that. So
Do
N,
begin mode.
it is.
Okay.
N is 10.
No. N is 5.
Oh, look at that one. Okay, N is 5. I is
6.
6. PV.
No PV.
Okay.
PMT 50,000.
Okay.
Solve for FE.
2987.
Yes, there we go. No wonder. Okay, so be careful. This one needed begin mode. Alright, so let's just highlight that. I almost forgot that. Okay, it's a good thing we went back and checked. Right. Okay, 12 is correct. 3. You got 3 right. 12, 3.
Yes.
Okay. 13. Let's see how this one went. Okay, Steve has set up a college fund in which he pays that each year payment. How much money will he have accumulated in the fund after 18 years in? And they want to know what future value is. If it's 7% compounded annually, I1. Okay, that's it. Simple. Alright, so payment equals 100, right?
1100.
1100. Ooh. Okay, 1100. The rate was?
The rate is 7%.
7%.
And the end is 18.
18 years, hey?
We need future value.
Alright, so for FE.
And it's option
18 years, yes. Okay, let's check. Okay, so equals FE brackets. The rate 7%. The N 18 years. The payment 1100. Close brackets solve. Did you get that?
Yes, it did. It's
Option 3. Good. 37398. Perfect. Right. 14. J deposits 25 into account. PV. Paying I. Compounded quarterly I4. How long does she have to wait? How long? So work out N. If she has that in the account, future value. Make sense? Okay, so let's jot those figures down.
So PV is 25,000.
FE
is 334,000.
Okay, I
is 7% divided by 4.
Okay, good. Solve for N. Alright, so N, the ratio was 0.07 divided by 4. Close brackets. Okay, the payment, no payment. The PV, negative 25. The future value, 334.
Yeah. And it's going to be
Close
option
brackets. That's quarters. Okay, this is quarters. Divide by 4 to get years. Okay, so this divide by 4 equals 37,35 years. What did they want it in? Janine deposits 25,000. 25,000 is correct. Into an account paying 7% annual interest compounded quarterly. 7% divided by 4, yes. 7% divided by 4, yes. Okay, that's the rate. Payment, nothing. That's the PV. Oh, that's the FE. This one might have been a typo. Okay. Because you don't get an option that's there. I get that quarters. If I divide by 4, I get 37,35 years. Just work it out again. Just double check. Okay, so let's just read it again. Janine deposits 25,000 PV 25 minus I 7% annual interest compounded quarterly, so it'll be 7 divided by 4. FE 334,000.
334,000, and we
Solve for N. You should get the same N. Yeah, it's fine. There's nothing wrong with our working. There's a problem with the answer. Okay, the N is 149 quarters. If you divide by 4, then you get years. Okay, so if I divide by 4, I don't get. There's errata here. Okay.
So then they'd have to give it to us, or not count it.
You'd have to just choose an answer.
But they would give it to us.
But they should. Okay. I suspect they probably didn't divide by 4. Okay, because dividing by 4 makes it bigger. So if we do not consider the quarterly compounding, right, then you would have the same thing here, except you're not going to have divide by 4. Okay, and then you delete that. Okay, there you get 38. See, 38.31, and then if you divide that by, you get 9.7. Also not there, so I don't know what they
I
did.
just checked that now.
Yeah, so I don't know what they did. Sometimes you can get the error because they make a mistake.
Yeah.
But don't do it that
sometimes
way.
they don't count it, or sometimes they will just give it to them.
Yeah, this one they should have checked before the exam. Okay, there's a mistake there. Okay. Right, the working is the working. There's nothing wrong with that. Okay. 5. T wants to buy a cemetery plot valued at that. She has applied for a loan from West Bank and has been requested to pay 20% of the purchase amount as a deposit. The balance will be financed. Okay, so the PV equals 1.5 million less brackets 20% of 1.5 million.
You had to work that out first.
Equals. Okay, let's see what we get there.
You get 300,000.
Yeah, which is 1.2.
Yeah.
Because
okay.
you're subtracting.
Yeah, minus, yeah.
Alright, so that's the deposit. Okay, so that's how much they're going to want. The deposit was 20% of the purchase price. The balance will be financed at 10% interest.
Yeah. It's divided by 2.
Over 30 years. Okay, we can put that just now. Let's just put that in. Okay. To which amount will her semi-annual repayment be closest? Okay, so semi-annual. Yeah, so you're right. So it needs to be divided by 2 year and times by 2. Good. Okay, and then solve for PMT. Right, the rate, let's check. 0.1 so divided by 2, close brackets. The N, 60. Ooh, the PV, 120, let's leave it as positive. 120, 0, 0, 0, 0, close bracket, equals 63.393.
Got it. It's option
4. Okay, good. You got it, eh?
Yeah.
Okay.
There was only that one I got wrong with that begin mode.
Yeah, that's fine. It's just a small little error. Okay.
Yeah.
Right. If your goal is to determine how effective a firm is managing assets, which of the following sets of ratios would you examine? Okay, remember this looking at managing assets. Okay, so quick ratio looks at your liquidity. That's definitely part of asset management. Debt ratio is looking at financing. Times interest earned is looking at financing. Okay, so those two are out.
Yeah.
Profit margin is profitability, which is a form of measurement in terms of assets, but it's looking at your sales and your profit. So not the best one. Current ratio, definitely. Fixed charge coverage ratio. I don't think you've covered that formula in your textbooks. That one's out. Okay. Number 3. Debt ratio is looking at financing. Price earnings is looking at a market value ratio. Return on assets is looking at your return. So return, definitely.
Yes, I took that one.
But the others are out.
Yeah.
Inventory turnover, how quickly am I selling stock? Yes. Days sales outstanding is looking at your debtors.
Yes.
Fixed asset turnover? Yes. Number
it's
4.
four.
Good. Okay, they're all assets, basically.
Yeah.
Or all dealing with assets. Right. The ratios are you still struggling with? Kind of. Or getting better?
It is getting a lot better.
Okay. Alright, so I think the last bit here in this question paper is probably ratios and maybe some bonds and shares later on. Okay, but...
And there's not many ratios actually.
Okay, so...
Because the ratios were
in the long
mainly
question.
asked in the long question.
Correct. Okay, so when I see this, when I read the question, exam technique is important. If they talk about financial leverage multiplier, I'm already thinking about DuPont.
Yeah.
Okay. Times FLM.
I don't know if I got this one.
Okay, so ROE equals NPM times TAT times FLM.
Okay, I got that.
Right, so there's the DuPont.
Yeah.
Right, they want to know what is it in 2016 only. So I'm only looking at that. Okay, return on equity 18.73%. 18.73%. Equals net profit margin 15.39%. Times total asset turnover given as 0.80. Okay, times FLM. Right, so solve for FLM. Right, so let's put the values in. 0.1873, okay, divide by, open brackets, it'll be 0.1539 times
That
0.80, close brackets, equals. Okay, that's FLM. Okay, I'm just doing some maths there. Okay, so let's copy that. Okay, 1.52.
Yeah, I didn't get that.
Option 3.
But I understand because I
Do you see what I did?
Yeah, I didn't include the 18.7.
Oh, you have
so I
to,
didn't do the,
because the
no, I
DuPont formula,
understand.
yeah, the DuPont formula
I got
is,
that now.
yeah, the DuPont formula is those 4 components.
I understand.
Okay, good. Right, so yeah, just make notes so you can see, oh, okay, that's what I need to consider. So next time round, you do the same thing and then you get it right. Okay. Right, it's good that you've practiced such a lot. I'm impressed. So keep it up, and you should get your distinction if you just keep doing what you're doing.
I'm hoping so.
Okay, you need to go back and do as many of those other past papers that you've got. Okay, because next week I'm going to do one more with you, the May-June 2017 paper, and then you've got a whole question bank for like 2016, 15, 14, 13. So try to do as many of them as you can.
And I was also doing online assessments because you need
Good.
to offer those. So I did all of them.
Nice.
Actually.
That's very good. Okay. Alright, 18. E has a current ratio of that, quick ratio of that, inventory turnover of that. What is the cost of goods sold? Okay, we need formulas here. Right, we had them earlier. I'm just going to go back and copy the formulas. Okay, we need quick, current. Okay, let's write them down. Okay, exam technique. Write the formulas down when you read them.
Okay. Quick, current, and inventory turnover.
Alright, so there's current. There's quick copy. And inventory turnover, hey?
Yes. So it's cost of goods
Copy.
over inventory.
Okay, paste. Right, there we go. We've got the 3. Okay, so I need to write down stuff that I've read in the question. So you go back and you reread. Current ratio 2.4. Okay, quick ratio 1.5. Inventory turnover 6 times. Okay, and current liabilities of 600. Where's current liabilities? There and there. Current liabilities 600,000. Okay, 600,000. Right, so then I look at it and I see, what am I working out? Cost of goods sold, so I want that. I don't have enough information here. The only place that I can start is there, because I've got 2 knowns and 1 unknown. Do you agree?
Yes.
Okay, so if I solve for my current assets will be 600 times 2.4 is that. Okay, then I put that in here. 1.5 equals brackets current assets 1440,123 minus I and V close brackets divided by 600,000. Right, take the 600 to that side, so it's 1.5 times 600.
Why is it negative?
What do you mean, why is it negative?
You put a negative.
Did I put a negative?
Yeah.
Oh, just a typo. Okay. Right, equals brackets 1440 minus inventory close brackets. Okay, inventory can go to that side. So inventory equals 144. Too many zeros there. Yeah?
Yeah, that's right.
Minus 900 equals. Okay, 540. Right, and where does that 540 go? It goes in there. Okay, so 6 equals COS divided by 540. Solve for C, that goes to that side, so it becomes times. So 6 times 540 equals COS. Right, so therefore COS equals 6 times 540. There's it.
Yay.
3.24.
Yes.
Option 4. Good. That's quite a tricky one, and you're getting it right. That's great. Okay.
I wasn't sure I was going to get it right.
Okay. 19 is theory. Which of the following would best explain a situation where the ratio of ROE of a company is higher, okay, than the industry average? This looks like a repeat question. Okay, while the ratio of ROA is lower than the industry average. Okay, so we need ROE and ROA. Okay, so just as a start, jot those formulas down, so at least we have a base to work with. Okay, ROE ROA. Okay, they tell you that you want an ROE that is higher than the industry. And you want an ROA that is lower. Okay, so number 1, the company's debt ratio is higher than the industry. Okay, so if it's debt, we need to look at ROE in terms of DuPont. Net profit margin times total asset turnover times financial leverage multiplier. Okay, we should actually write down the formula as well for DuPont. So I'm just going to get it. Yeah, it's this one. DuPont right at the end. This long one, that one. Okay, so paste that. Okay, so they tell me that the debt ratio, wrong spot. Okay, debt ratio is higher than the industry average. Okay, so the debt ratio is total liabilities divided by total assets, if I remember correct. Let's check that. Is debt ratio right? Liquidity. Where's the debt ratio? Here. Total liability. Oh, yes, that's right. Okay, so they tell you that the debt ratio is higher. So if the debt ratio is higher, your liabilities are more than your equity. So your equity will be less than your assets. So in other words, TE over TA will be smaller. Right, if debt ratio bigger. Make sense?
Yeah.
Alright, so if this is smaller, then if I swap that around, total assets over ordinary shareholder equity, so therefore TA over TE will be bigger. Okay, because the smaller this is, if you inverse it, it'll get bigger. Okay, so it will be bigger. Therefore, making ROE bigger as well. Right, so that one's actually true. So looking at that, that first one is true. The company's net profit margin is higher than the industry average. Okay, if the net profit margin is higher, so then NPM is higher. If NPM is higher, ROE will be higher. ROE of the company is higher than the industry, while the ratio of the ROA is lower. Okay, but remember, ROA is NPM times TAT. Right, so that'll also be higher. That one's out. Okay. Total asset turnover is higher. If TAT is higher, that'll be higher, and so will this. That one's out. The financial leverage is lower than the industry. If the financial leverage is lower, then that means this is smaller, then it'll make that smaller. It's wrong.
Yeah, it's option 1.
I think it's a repeat question. It looks very similar.
It does.
Okay. Right, number 20. More time value of money, but apply to bonds. Possibly. No, not yet. Okay, what is the real rate of interest on your investment if the current inflation is that, and you have an investment opportunity that pays 12% with a risk premium of 2. Okay, here they want the real rate. Okay, so real equals nominal minus inflation. Okay, so they tell you that the investment opportunity pays 12% and it has a risk premium. Okay, so the risk premium is 2%, but the return is 12%. So it's just 12 minus 6. Okay, because the risk premium is already part of the return.
So 6.
12 minus 6.
I was getting so confused.
Yeah. Okay, so because they tell you that the investment pays 12%, only because they tell you it pays 12%. Minus 6% is 6%. Okay.
That was the first one that I cancelled out.
Oh, okay. Alright, number 21.
Well, I've only gotten 2 wrong so far.
Yeah, it's looking good. Okay, so don't stress. Right. A has an outstanding bond, okay, FE, matures in 6 years, N, which pays interest every 6 months. That's half yearly. So that's payment. Is currently selling for that. What is the bond's yield to maturity, which is your I? Okay, so we're just literally putting in values. FV is 1,000. PV is 91137.
Yes. N is 6 years.
N is 6 times 2.
Yeah.
6 times 2. PMT is 40. Right. Solve for I.
We don't need to say 40 times 2.
No, because the payment is given as it pays 40 rand.
Okay, because it's just a bit confusing. It says which 40 interest every 6 months. So I was just
it says 40. Yeah, okay. So 40 is the payment every half year. Okay, the N here 12. The payment 40. The PV negative 911.37. The future value 1,000. Close brackets. That's the rate.
Yes.
But no, be careful. That rate is what? I2. So you have to times it by 2 to get YTM, yield to maturity. Okay, so it's actually 10% times 2.
No, but they should give me the answer.
Okay, because they ask for yield to maturity. Okay, so times by 100 gives you 10%. Okay, so 10% here, 4. Okay, we're doing good.
Yes.
Okay, 22. Theory. When a financial manager is faced with a normal yield curve, so normal means that, on what will he or she most likely be relying heavily? Cheaper short-term financing? Yes. Cheaper long-term financing? No. More expensive long-term financing? Yes. More expensive long-term financing? More expensive short-term? No. More expensive long-term? Yes. But they'll rely on the cheaper. So 1.
Yay.
Okay, 23. Right. Izzy has bonds in the market, 13 years, 2 maturities. That's N. A yield to maturity 10%, I. Current price, PV. The bonds make annual payments. Okay, so annual payments every half year. Okay, what must the coupon rate be? Okay, they're solving for PMT. Right, so future value, you need a future value here. It'll be 1,000. Okay, you have to assume 1,000 as the base. Okay, the present value, otherwise you can't work it out. Present value 1, 2, 3. Yield to maturity 10%, but it's I2.
2, yeah.
10% divided by 2. Okay. What else? N 13 years. N equals 13 times 2. Right. Solve for PMT. Okay, let's see what we get. Alright, so PMT is, the rate is 10 divided by 2.
Which is 5.
The N is 26. The PV negative 1123. The future value 1,000. Close brackets.
Where did you get 1,000 from, man?
You have to assume that, otherwise you can't work it out. You need a face value.
So is FE always going to be 1,000 unless they state
Well,
otherwise?
a PV will always be close to the face value. So if it's less than 1,000, it'll be at a discount. If it's more than 1,000, at a premium. Okay, but the base will be 1,000. Yeah, just as a general rule of thumb. Okay, so only because you were given 1,123 with the face value, I assume to be 1,000. Okay, but then we need to work out the payment. So payment equals coupon rate times face value equals 58 Rand 56 divided by 2. Okay, it's divided by 2 because it's half yearly, equals 58, comma 56. Okay, so let's work that out. So the payment we already know is 56, so we need to times that by 2. So coupon rate times face value equals 2 times that. So 58.56 times 2 is that. Okay, the coupon rate is a percentage, the face value is 1,000. Okay, so coupon rate is that divided by 1,000. 11.7% times.
I got that, but that was a guess.
Okay, that's good. Okay.
I didn't know that future value thing.
Okay, careful. Now we do. So just remember that if they don't give you a future value, assume that it's close to the present value.
Okay.
Right? They should actually, but they don't. But it's fine.
Oh,
we can
a
still
trick question.
possibly, yeah. So what is the answer? 2.
So I've only gotten 3 wrong so far.
Yeah, but you've got lots more right. That's fine.
No, I've only got,
Alright, what happens when the expected cash flows of a bond are discounted at a rate lower than the coupon rate of the bond? Okay, if the discount rate is lower than the coupon, the coupon is higher. So if the coupon's higher, the bond is at a premium. Yes, the bond will sell at a premium, number 1.
I got that on the book.
Yeah, that's the theory question.
Yeah, it's either selling at premium, selling at
or
a
discount or
par.
par.
Yeah.
Correct. Okay, Peter wants to invest in a bond with a par value. There's FV. Price of the bond, PV. Pays a coupon, 10%. The current interest rate is 12%. How much time is left to maturity? Okay, so working on N. Let's put in those values. FV, 1,000. PV,
862.35.
862.35.
Yes.
Coupon 10%. PMT equals 10% of 1,000 is
100.
correct.
12%
12% I. Good. Solve for N. Make sense? Okay, N periods equals the rate here 0.12, the payment here 100, the PV negative 862.35, the future value 1,000, close brackets, there's the N, that's in years. Yeah, so 15.43, option 2. Okay, imagine a bond selling for that, PV. The par value, FV. The yield to maturity, I. The time to maturity, N. What is the coupon payment? Solve for PMT. That's easy.
Yeah.
Okay, so PV, 105346, 1053.46. FV is 1,000. Right? Yield to maturity, 6%, 3 years. N is 3, I is 6. Solve for PMT, right?
It's 80.
Okay, let's check. PMT brackets. The rate is 6%. 3 minus 1053.46. 1,000 close brackets equals 80. Yes, that's right. It's good.
Option 2.
Okay, 27. Cola is selling 16-year bonds with a par value.
That's FE.
No, yield to maturity, or I. How much would you pay for the bond?
That's the
Okay,
present value.
there's your N. Yeah, so present value is what we're working out. So you've got N, you've got FE. You can assume this is a zero coupon bond if they don't talk about a coupon. Alright, so N is 16. Future value is 1,000. Yield to maturity 5%.
Yep.
I equals 5.
The answer
Okay,
is 4
solve for PV. There's no half yearly here. Just double check.
Nothing.
Nothing, eh?
Nothing.
Okay, PV. Rates 5%.
That's the first thing that I check.
16. Payment 0. Future value
1,000.
1,000.
The answer is 4, 5, 8, 11.
Correct.
Yay.
4, 5, 8, 11 is 1. Good. Okay, last few. 28. Right, now we're looking at, okay, still bonds. Constant is issuing a bond at a maturity of 13. That's N. After which 16,000 will be paid to the bondholder. Okay, that's the time value of money one. The market interest rate is that. The bond holder receives a coupon of that. That's payment.
Yeah.
What amount is the bond selling for present? So PV question mark. Okay, after which, okay, so after which, that's actually the future value. Okay, after which
That's
it'll be
what I
paid.
put it as,
Yeah, so that's fine. Okay, so N equals 13.
N is 13.
Future value?
16.
Rate? 8.36.
Yeah.
8, 36%.
The PMT is 2161.
2161.
And we work here PV.
That's it, eh? Yeah.
Yep.
Solve for PV equals, let's see. Okay, so PV brackets. The rate 0.0836. Okay, in here 13. Payments.
Payment is 2161.
Future value 16. Did you get 22?
Yes, I did.
Option 3.
Option 3.
Good. Okay, 29. What is the rate of return earned for investment G during the unspecified period? Cash flow during the period, beginning and end. Okay, so this is your PMT. That's your beginning. So that's your PV. That's your N. That's your FV. What is the rate that's returned? So this wouldn't be a. It would be your. What is it? Cost over cost. Okay, so future value plus cash flow divided by costs. I would use a different formula because they don't tell me about the time. Okay, so let's write that down. Rates equals brackets your end value plus your cash flow close brackets divided by the initial costs. Okay, because they didn't give you any, so I'm using maths here instead of a formula. Okay, so the end value was what? End period 21,000 plus how much cash flow did I get? 1,500. Close brackets divide by beginning of the period 20,000. Okay, gives me an amount. It'll be 1 comma something. We want the comma something. Okay, there's it. 12.5%.
Yes, got it.
Option 3. Okay, good. 30. Given the following information, what is the standard deviation of the following investment? Okay, this is requiring your table method. Alright, so let's go get a table. Let's just use this one. Okay. Right, so here's your workings. What question number is this?
This is question 30.
Okay, question 30. table method. Alright, so okay, all this other stuff we can delete. Okay. Alright, so you'd have to draw up your table. Probability 0.4, 0.6. Probability 0.4, 0.6.
So there's
Only two. Return 20 and 10. So 20 and 10. Right, standard deviation. There's the answer. Okay. 14% is the expected return which they gave you. Okay, so there's the expected return. Alright?
Okay.
You have to put it in the table, you have to do the table, and your standard deviation is that. Times by 100 to get 4.898 percent. Make sense?
Yes.
Okay, so that requires a table. 4.9. 4.89, number 1. Make sense?
Yes.
Okay, so number 1 here. Okay. Try to do a few of those tables because sometimes they do give you a big question. In one of the past papers, they actually asked the long question was that table.
Yeah.
You had to draw up a whole table. Yeah,
No,
so
I'm going to
it
learn
can
that
be worth quite a lot of marks. Okay.
Okay.
Right, market risk premium of the share is that. Risk-free, RF. Required return, RR. What is the beta coefficient? Okay, so that we can work out. Okay, so the required return is 8%. The risk-free is 5%. Plus, what is the beta?
Beta.
Oh, we're working out beta.
Yeah.
Okay, so beta. Brackets. The market risk premium was 7%. So that's actually 7%. Can we check that again? I always forget. Just pass your textbook quick, if you don't mind. Which one is the market risk premium? I think the market risk premium is the whole thing, but I could be wrong.
Yeah.
Let's just double check. Okay. Market risk premium 325. 325. Okay, so the RM minus RF portion is the risk premium. Of the risk premium is called the market risk premium. Yeah, so it's right. Okay, so that part is called the market risk premium.
Okay.
Is called the risk premium. What did they say in the question?
If
the market risk premium
of a share is equal to 7%, the risk-free rate
Oh, okay, they've actually made a mistake. Because if you read the textbook here, the market risk premium, the RM minus RF portion of the risk premium is called, okay, it's right. Okay, so it is this part. It's correct at that part. Okay. Thanks. Okay, so that's fine. Let's work it out then. Okay, so take the 8, leave the 8, take the 5 across. So 8 minus 5 is 3. 7% beta. Okay, solve for beta. Right, so beta equals 3% divided by 7%. Okay, which is 0.03 divided by 0.07. Let's just do 3 divided by 7. That might be better. 3 divided by 7
is 0.42. It's the same answer.
Right, eh? Okay, it was right. 0.4243. 0.42.
Option 2. I didn't get that wrong.
Yeah, it's just using cap M, but remembering that this part of the question is called, so this is called the market risk premium. The whole thing is called the risk premium.
Okay.
Okay. I must just remember that. Always forget which is which. Okay, 32. Right, a share has a beta of that, expected return of that, and a risk-free of that. What is the expected return of the share? That's easy. Okay, so you're doing capping. Okay, required return equals risk-free. Let's just copy this, paste. Okay, so share has a beta of 1.88. Okay, so R equals, what is risk-free?
Risk-free is
5%.
5.
So 5 plus beta 1.88.
Yes.
Okay, market return
14%.
14 minus 5, close brackets. Great, let's work it out. RR equals 5 plus 1.88 times 14 minus 5 is 9, close bracket. 21.92. Option 3. Okay, assume you are a risk-adverse investor. Which of the following? Correct. Okay, which of the following would you select? Standard deviation. You want standard deviation to be lower. So that one. Expected return you want to be higher. So that one. So Sky. Sky, as it has the highest expected return. Sky, as it has the lowest coefficient of variation. Yes. Number 2.
So it always has to be the lowest.
Okay, because what is coefficient of variation?
Standard deviation squared.
Coefficient of variation, let's just check. Standard deviation. No, standard deviation is C. Standard deviation is standard deviation divided by expected return.
Okay.
Yeah, standard deviation divided by expected return. Okay, so Sky is the best. Alright, it has the least amount of risk. Okay. Number 32. Okay. Right, pref share pays the annual dividend of that per share. If investors require 8%, okay, that's a PV equals div over I. Okay, it's like a perpetuity payment over I. Okay, so PV equals PMT divided by I. Okay, PV equals, what is the payment? 8 rand, 6 rand 8. 6.8.
Yeah.
Divided by, what is the rate?
8.
0.08 equals. Yep. 3. Okay, K has a recent dividend. Recent dividend, div 0. The dividends are expected to grow at 4%. That's G. If the required return, that's R.
So
how much will you pay?
G, so
it's div 1. So it's normal. PV
equals div 1 over R minus G.
Correct. Okay, we don't have div 1. We need to get div 1. Okay, so div 1 equals div 0 times 1 times 1 plus growth, just to show it more workings. Okay, so what is div 0? 5 rand.
Yeah.
Okay, so 5 rand, what is the growth? 4%.
So it's
0.04. Okay, so div 1.
It's 5.2.
Div 1 equals 5 times 1.04. 5.2 is correct. Okay, so PV equals 5.2 divided by open brackets 12 minus 4, 0.12.
Yeah. It's 65. It's option
65.
Yeah.
Option 4. Good. Okay. Right, next one. C's next dividend, div 1. The dividends are anticipated to maintain at 6% growth rate forever, G. If the company shares are selling at 40 Rand, PV, what is the required return? Solve for R. Okay, so same formula, copy paste. The price is 40 Rand. 40 Rand equals Div 1, the next dividend is 7 Rand per share, so it's 7. Divided by, open brackets, R minus G. Growth here was 6%. 0.06, close bracket, solve for G. Not solve for G, solve for R. Okay, so it'll be 40 times, open brackets, R minus 0.06, close brackets, equals 7. Do you agree? Okay, so that's 40R minus. Can you type that in? Okay, can I use this quick? 40 times 0.06 is 2.4. 2.4. Right, equals 7. Okay, so take the 2.4 across, so 40R equals 7 minus 2.4. 40R equals 7 minus 2.4, 4.6. Okay, so R equals 4.6 divided by 40, which is 4.6 divided by 40, 11.5%. Not there, hey?
I don't know how, but I got.
Let me see if I made a mistake. Let's see. 40, selling for 40 Rand. The dividend is 7. The growth is 6. Maybe I made a mistake with the maths here. Let's see. Div 1 over R minus G. 40 equals 7, brackets, R minus G. Okay, take that across. If I take that across, it becomes multiply. 40 times R. Oh, here's the mistake. Okay, this is 40 minus 2.4. If minus 2.4 goes across, it becomes plus, not minus. Sorry.
I got 12.5.
Yeah. Plus here. Made a mistake with the sign. Okay, it should be a plus here. So it's 9.4. So this should be 9.4. Okay, so it's 9.4. 9.4 divided by 40. 9.4 divided by 40. No, it's 23.5. Okay, it's option 3 actually. Okay. Right, so just be careful with the maths. Just watch the signs. I made a mistake with the signs. Okay. Right, perfect shares are selling for that. That's PV. The expected dividend 1 year from now is 15. So that's Div 1. Required return, that's R. What is the growth rate? Now we're solving for G. Okay, so same formula again. Copy paste. Right, your present value 187.50. 187.50 equals Div 1 is 15 Rand. Required return 15%. 15 divided by open brackets 0.15 minus G. Make sense? Solve for G. Okay, take that across. 187.50 times open brackets 0.15 minus G. Close brackets equals 15. Right, 187.5 times 0.15 is that minus 187.5 G equals 15. Okay, take G across, take the minus 15 that side. So this minus 15 is that equals 187.5 G. Right, solve for G. Okay, so G equals 13.125 divided by 187.5 gives you 7%.
Yeah.
You get that, eh? Nice. 1. These are quite difficult in terms of math, so if you're getting them right, that's very good.
There's 1 or 2 that I've gotten wrong, but yeah.
Okay, theory here. Which one of the following statements about the difference between ordinary shares and preference shares is correct? Preference shareholders referred to as residual? No, that's ordinary.
Yeah.
Ordinary are given preference? No, it's the other way around. The claims of preference shareholders must be satisfied before the board of directors declares dividend? Yes. Preference shares are super voting shares? No. Sometimes they don't even have voting. Yeah, 3 is correct. That's just theory. Okay, 39. Is shares currently sell for that? That's PV. Market requires a return. That's R on a company share. Maintains a constant growth. That's G. What is the most recent dividend? Most recent dividend, div? 0. Okay, be careful. Alright, so copy paste. Right, so what is my PV here? PV 21. 21 equals div 1, we're working out the dividend. The rate was 12 and the growth was 5. Div 1 equals 0.12 minus 0.05, close brackets. Okay, so 21 divide here. There we go. There. Okay, so let's work it out. Take that across. So it'll be 21 times open brackets 0.12 minus 0.05 close brackets. Okay, there's a missing bracket here. Okay, equals div 1. Right, solve for div 1. Div 1 is 21 divided by open brackets, no, times. Times is this. Okay, 0.12 minus 0.15, close brackets, there, 1.47. That's the dividend. Okay, so div 1 equals div 0 times open brackets 1 plus growth. Okay, so div 1 is 1.47 equals div 0 times brackets 1 comma 05 close brackets. Okay, so solve for div 0. Div 0 is 1.47 divided by 1.05 gives you 1.4. Got that right?
Yeah.
Nice. Sure, that's good, eh? Okay. Right, then last one, number 40. If had earnings of that available for ordinary shareholders, to 25,000 ordinary shares, price earnings. Okay, it's a ratio question. Okay, I need PE, price earnings ratio. Should be here. There, price earnings ratio. Write down the formula. What else do they say in the question? What is the current share price? Okay, that's it. So price earnings is 18. So 18 equals, they want to know what the market price is. So I won't know what the price is. Divided by EPS. Okay, EPS, I need a formula for EPS as well. Let's get that. There's EPS, copy paste. Okay, so I need to get EPS. Earnings available 150,000 and 25,000 ordinary shares. Okay, so EPS 150,000 divided by 25,000 shares. Make sense?
Yes.
Six. Okay, so then that goes here. So it's 18 equals price divided by 6. Solve for price. Price equals 18 times 6.
Gives you 108.
Does it?
That sounds like
Yes. Well done. Okay, 4. Alright, it's looking good, eh? You're getting, so out of 40 multiple choice, you got 3 wrong.
4.
4 wrong. Okay, that's very good. That's impressive. 4 wrong is 36 out of 40. That's 90%. Okay, and that's multiple choice. So that's very good. Just be careful not to make any little small or minor errors.
Yeah.
Okay, but otherwise you can get 100 for this. Yeah.
Hopefully they
Well
give
done.
us easy questions. Oh, questions like that.